All right. Hello, everyone, and welcome to another edition of the Dividend Power Hour, our weekly show where I get to check in with you fine folks. Wherever you're tuning in, let me know in the comments section. Where are you tuning in? And did you make any purchases this week? Did you make any new additions to your portfolio? Maybe you sold some stocks, but we did get that bounce that a lot of us were expecting this week. We talked about it on the Dividend Power Hour last week. And if you are a subscriber to my weekly newsletter, we did a full update there as well, talking about the bounce we expected here coming into this very week right now. So we're up against another key level. We have a lot of things to talk to. We got about today, a lot of earnings reports coming in. But first and foremost, my name is Mark Roos, and I'm a CPA here in the state of California. Thanks for tuning in with me today or tonight, wherever you may be tuning in from. Again, let me know, where are you guys watching from today when it comes to the Dividend Power Hour, and what, if any, purchases did you make to your portfolio? I would love to hear it. Had a new video come out this week talking about, I know there were some people with, it hit them the wrong way when I was talking about SCHD and some another potential ETF option to look at. But, maybe I made some updates there when it came to that ETF, which we were talking about there, which is VIG. So let me know where you're tuning in from. Michael, hello, everyone. Was hoping for another dip today. We always like to buy those dips. Matthew, good to see you again, a regular attender. And welcome to all of those of you that are tuning in for the very first time. It's great to have you here. We got New York in the house with Ron. Ron, good to see you again. Delaware with Diana. Canada's in the house here with a need. Michael's tuning in from Texas. Bought a bunch of stuff. Oh, let's hear it, Michael. Singapore. Sean, good to see you, my friend. Bought some O. Ron bought some Microsoft and GEV. John Bircher, good to see you. Tom, hello. Chris, tuning in from Phoenix, Arizona. Minnesota. Drew, good to see you. Tom, New Jersey. Jeff Hansen, good to see you from Minneapolis. Took some profits this week. Okay. Rob Roos, good to see you. Mexico City in the house. Nice. Philadelphia. More New Jersey. Bought some JEPQ. All right. So the East Coast so far, New York, New Jersey, definitely the most tuning in. Pennsylvania's up there. Picked up some VIX. James, good to see you. Wow, we got a great group so far here on this edition of the Dividend Power Hour. Ohio. Kath, good to see you. Jeffrey Hatch, good to see you, my friend, up in Washington. We make any new additions this week, Jeffrey, or Kath, or Brett? Let me know down in the comment section. Again, if this is your first time, this is meant to be interactive. I'm going to go through high level on some key stories that hit the market so far. We'll go through some earnings. We're going to have a little fun today, too. We have the NFL draft that'll be starting. So for all of you, those of you that are sports fans, you're going to be excited in front of rooting for your favorite team to make the right draft pick there moving forward. But we're going to do it even if you're not into sports. We're going to do a stock market edition of the NFL draft here, and you're going to put on your general manager hat and pick your 3 stock portfolio. So today's edition is going to be a little bit fun. We're still going to go through a lot of our data, touch on some of those key points, look at a few of those key earnings reports as well. So let me tune in real quick and see what else we got. We got California's in the house. John did some buying, HDV, XLV, and some VIG. John must have watched the latest edition of our video. Jep Q. I'm watching from work instead of working. Uh-oh. Chipotle was bought here. Chipotle released earnings today. Orlando, Florida. All right, Jeff, what do we get? Jeffrey picked up some Visa shares before earnings today. Or I guess yesterday was when they did it. Awesome. So let me throw up our regular slide deck, which if you are returning, this looks pretty much the same as it did last week. Not a ton of movement overall. We did get that bounce, but we have a few new points that we want to make here. So let's first go through our markets update. As you can see, these are year-to-date figures. So we have the Dow Jones, the S&P 500, the NASDAQ, and the Russell 2000 that we look at each week. The previous week there is the year-to-date figures that were when I did the Dividend Power Hour last week. So you can kind of see a nice bump there in the Dow Jones, which a lot of that had to do with United Health Group. That's the largest company within the Dow Jones. And for those of you that are unaware, the Dow Jones is actually a price-weighted index. S&P 500, market cap weighted. The Dow Jones is price weighted. So the companies that have the highest per share price have the largest weighting, irregardless of how large that actual company is compared to others there. So something unique that not a lot of folks know about right there. So that's the Dow Jones, had a nice move higher, largely due to United Health. S&P 500 up about 100 basis points or so. Last week was up 5.3. This week up 6.3. The NASDAQ was kind of just muted. We saw the dip and we've returned back to those levels. So we're up 4.6. I think it's like 4.65%. So you could say that we are pretty much even compared to where we were last week. And then the Russell 2000. This is those small caps. And when we get hit, if we fall into a recession or interest rates stay elevated, small caps can tend to get a little bit more hurt. However, when rates start to come down, this is going to be an area to look at. So if you're a long-term investor, maybe an area to start, picking out some key small caps, or just go in the IWM. That's a route that I use on a regular basis. IWM is the small cap, the Russell 2000, I should say, ETF, low cost there from that standpoint there. So Russell was down about 2.2% last week when we had our Dividend Power Hour, crawled back a little bit, getting closer towards those green figures, but we're still down about 1% overall. Given the pullback and the updates in earnings there, the 2024 S&P 500 PE multiple on a forward-looking basis sits at about 19.9. So the first time we've seen nothing with starting with a 2 in a number of 6+ months per se there. So valuation starting to look a little bit more intriguing looking at the S&P 500 as a whole. And for comparable purposes, if you're wondering, okay, great, 19.9, where is it usually? Well, over the past decade, closer to 17.6. In terms of interest rates sit at 4.65 on the 10-year, 4.94 when looking at the 2-year. Again, it was volatile over the past 5 days, but has kind of leveled out, seeing a big dip and crawling back there. Earnings season has begun, and nearly 20% of the S&P 500 has reported so far, and 75% of those companies that have reported have beat expectations. That's a good trend there so far, but still 80% of the S&P 500 still to go. We still have a major week of earnings. We still have a few companies this week to report so far, and then big tech next week when we get into the Microsofts of the world, as well as Apple and many others. So the market has rebounded. We were in a kind of that fear factor moment last week when a lot of investors, we were coming here to the Dividend Power Hour wondering, is this the end? Is this the beginning of the pullback? Am I going to lose everything I've made over the past year? And we've got that bounce. Now, as an investor, you have to ask yourself and take a step back all the time and say, is this a dead cat bounce? And for those of you new to investing, or maybe you haven't heard that term before, that's usually like a bounce that maybe it's not as deserving. A dead cat bounce is the stock or an index has been falling so much that it's just going to recover slightly, but then you're going to see the money right after that dead cat bounce and it comes up a little bit. Boom. That's that capitulation moment when everyone sells. Think of that moment when we haven't had that yet. Everyone was fearful last week. However, we were only down 5%. We weren't even technically in a correction. We were only halfway to a correction. The definition of a correction in the index is 10% from its recent highs. We were only down about 5%. So it seemed worse than it was. It was only about 5%. But now we got to ask ourselves, okay, we've recovered a bit here. We've had a nice little rally here in the past 5 days since our last Dividend Power Hour. Is this going to continue moving forward? Is that the bottom there? Or is this just a quick turnaround and then the flush out that we have yet to see yet? That's what concerns me as an investor, is we haven't had that flush out moment yet. That's when all of those retail investors just sell, sell, sell. Right after, though, right before that, I should say, is when all the hedge fund managers, those are the folks that can actually move the market in one direction or not. And again, remember, we've talked about it a few times on the Dividend Power Hour before, is the large money. Think of the Warren Buffetts, those big hedge funds. If they want to sell, they can't sell all at once because there's not enough buyers out there, retail buyers, to match up with. So what do? They sell in tranches. They're going to sell a little bit now. That'll pull the whole market down. Then they're hoping that the market creeps back a little bit higher, which is what we've seen. And then they get to sell another tranche, because if they sell everything, they're going to be selling all the way down and not be getting the prices that they were hoping. So by doing it in tranches, they're hoping to get a bit of a bounce back, which is what we've seen. So we're in that area. We're going to look more at it here in a little bit, but just want to make you aware of kind of the cycles that we go through when it comes to investing. So that's where we're standing right now on the interest rates. And we'll take a look at the graph here in a second. We have earnings season underway. We got the market rebound. And what about housing? We got the March sales report came out. New home sales posted its biggest jump in over a year. Sales increased about 9%. during the month of March. Spring selling season, spring buying season, whether you're a buyer or seller, is underway there, and things look promising so far in March. It's a good bounce back from what we saw, I should say, in the prior month. So here's our fear and greed index. Just 2-3 sessions ago on the Dividend Power Hour, that was sitting over in the extreme greed area, right between greed and extreme greed. We were right on the border there. And then boom, last week we dropped all the way over here to the fear levels. We still sit in those fear levels, even given the kind of the pullback there. And I think that's a good spot to be in. I think investors right now shouldn't be saying, okay, the markets are moving back higher now. Let's pour it all in. We've touched the bottom. It's time to take off for the rest of the year. You still want to be defensive. You want to be mindful of what I was just talking about. The big money doesn't sell all at once, or the market would just flush out and they wouldn't get the prices they want. They want to buy low and sell high. If they sell it all at once, they're going to be selling on the way down. They don't want to do that. Neither do we. But that's the name of the game. So fear levels still high, sitting at a grade of about 41 here so far. So let's move over to the iPad here and take a look at a few things. Let me get that set up for you guys so that you can see what's going on. Hopefully everyone's week is going good so far. We're only 3 days into it. I guess we're halfway. It's hump day, right? All right. So let's take a look here at the iPad and start with interest rates. We were talking about the 10 and the 2-year getting a little bit volatile this week, but things have kind of leveled out overall. So let's take a look at the 10-year over the past 5 days. You can see it dropped kind of all the way down there to a little over 4.5, increased as high as 4.67, but we've kind of leveled out from that standpoint. We're at 4.65 there on the 10-year. If you scroll out over to the 2-year, I should say, that's where things also have kind of leveled out. We got up to 5% when it came to the 2-year. So let's go back to the treasuries here. We go to finance, and this is the Wall Street Journal for those of you wondering. You can look at this free. You don't need a subscription or anything like that. So if we go over here to the 2-year note, let's look at the past. If you can see the past 5 days, down about 5.8 overall. 1 month up 30 ticks there overall. Now let's move on to the Fed. So we're approaching our next Fed meeting. And today, I feel like we've talked about it a lot over the past few Dividend Power Hours is the Fed interest rates. I'm going to try today and not talk a lot about that because I think it's kind of status quo. I think we've kind of nailed that in the head so far a number of times. Let's wait for some new data coming out. We got PCE that's coming out. Consumer sentiment will be coming out Friday. That's just saying consumers overall, how do you feel about the economy moving forward? That'll be the consumer sentiment report. And then PCE, which is really the gauge. That's the inflation gauge that the Federal Reserve is going to be looking at. So let's just quickly see where the futures market is overall in terms of price hikes. So this is the CME, the normal Fed Watch tool that we look at each and every week. If we go to probabilities here, scroll in there, we can see how many rate cuts are being priced into the market right now. So we're, again, sitting at that 5.25, 5.5 range right now. We're expected to be in that range through July at least. And then not until September or November is the first expected rate cut. Now, whether you believe we're going to get a rate cut or not, I mean, it's only 46%, so it's not really that telling right now on whether we're going to actually get a rate cut. So only about 46, 43% when it comes to rate cuts in either the September meeting or the November meeting. Otherwise, we'll be sitting at a rate cut looking at December. So December is going to be the likely one. I think it's going to be that November, December is when we're going to get it, but it's all going to be data dependent. We all have to watch it. Again, the March inflation report, not good at all. Whatever way you look at it, that March inflation report was not good. We're going to get PCE now, and let's see how that's going to be doing. But we don't want to make and jump to conclusions based on one single report here. So let's look at April's report and keep moving forward and adjust it. It's going to be a moving target from that standpoint there. So still in the camp of around one rate cut, but a lot of people are starting to price in 0 rate cuts, and that's going to change. What do I mean by pricing in? Well, that changes a lot of models when it comes to valuating stocks. If you're going to put a value on a stock and you believe rates are going to come down, if that company is one that utilizes debt or has a lot of variable debt and rates are coming down, that's going to be beneficial to that type of company. Now, if you have another company that's relying heavily on debt and rates are going to stay elevated, it's going to be a downfall on that type of company. So you need to look at your portfolio and understand its debt balance. You always constantly want to be looking at debt balance. Some of the metrics I like to use are debt to EBITDA. EBITDA means earnings before interest, taxes, depreciation, and amortization, something we look at for those of you that have joined my 6-week investing accelerator course and gone through that. And a number of you have signed up. We had over 10 new people sign up for the investing accelerator course this past week when we opened enrollment. We had a special for a few of those that came in. Those spots went out within 36 hours there. And we had a number of other new folks that have joined it. So we are packed to the gills right now in terms of that. So we do have a waiting list. If you are interested in taking that, there'll be some more information later on. But this is what we want to be mindful of, is when you are investing in individual stocks, you got to understand how to evaluate them. You got to constantly evaluate them. It's a little bit more work. You can't just invest and go away. You know, you sell in May and go away, but you can't just invest and go away when investing in individual stocks. There's really no forever stocks out there. I know I do videos on forever stocks, but they still require homework. It's invest in homework. It's not invest and go away, come back and hope Apple's higher in a decade. You still got to stay up with it. I still think it's, you know, there are multiple forever stocks that are out there, just given the prior performance, the current management, the direction that they're going, things that are coming out, but you still got to do your homework. So just be mindful of that. If you have a portfolio that has a lot of individual stocks in it, it can, number one, add a lot more volatility. You're going to be a lot more reliant on one individual company, and it requires a lot more homework on your end. So that's that little blurb. All right, let's keep rolling here. Let's look at some dividend increases. Didn't really have any notable ones here. When it came to dividend increases, we could see Johnson & Johnson increased about 4.2%. That was last week. You got Anheuser-Busch bringing their dividend there up. What else do we got? What other notable companies do we have increasing? SLB increased at about 10%. I don't think that, Southern with about a 3% dividend hike. So nothing crazy in terms of dividend hikes this week. So that is the story there. Now let's get back to our slide deck and let's take a look at sector performance. So I always like to update you guys on which sectors are working, because you want to understand, number one, economic cycles, which sectors are working, so that we can confirm which cycle we're in. Because if you have a better idea on where we're at in terms of the economic cycle, then you have a better understanding of which sectors you want to be overextended on and which sectors you want to be underextended on. Certain sectors work when times are good. Certain sectors work better when times are rough. If you need to get defensive and the economy is starting to slow down, you can still make money in the stock market. You just need to move more towards defensive sectors, things like healthcare, utilities, and stuff like that. So let's take a look and see how sectors are doing overall here. So looking back at the iPad now, we can see, let's look at year to date. So year to date, communication services, still a leader. It was a top 2 leader last year. At the end of 2023, it's continuing its momentum here. That's likely going to take a hit because its largest position within that sector is Meta Platforms, which is getting hammered after hours right here. So energy is likely to take the lead here in terms of a year-to-date performance. So energy has just been rock solid. It continues to be a sector that I continue to talk about on the Dividend Power Hour. I keep telling you guys the way that I invest in it. I can go XLE, that's going to be energy as a whole. Top 2 positions are Chevron and ExxonMobil. I can go IEO. These are companies that are oil and gas companies, but it pulls out those 2 large companies in Chevron and Exxon. By investing in the XLE, I already have plenty of exposure to them. So IEO takes it a step further into some of those other companies. ConocoPhillips is an individual stock I own. It also happens to be the largest position within IEO. So those are kind of the ways that I play energy so far. Financials has been performing quite well. And when financials is a leader, that's usually a good sign moving forward. This is something that a lot of folks aren't talking about right now, is how well financials are doing. So that they came out with reports. We had JP Morgan, we had Wells Fargo, we had Bank of America, already have reported their latest earnings. A lot of what we've expected. Net interest income kind of muted overall, not really growing anymore, or even coming down slightly for a few of the companies. And for those of you wondering, what in the world are you talking about? What is net interest income? Net interest income is the difference. The easiest way to think about it, net interest income is the difference between the interest that the banks earn from loans. So if you have a 30-year mortgage, think of it, and you pay Bank of America, they're earning 7%, 7.5% on that 30-year mortgage right now. Well, they also have to pay out money, though, for savings accounts that you have with them. So maybe it's a 2% savings account. So the difference between what they're earning and what they're paying out can be thought of as that net interest income or net interest margin, depending on how you want to look at it from that standpoint. So during an interest rate hike, interest rates are going higher. Interest rates are going from 3 to 4 to 5 to 7. Banks can earn a lot more money during those periods. And trust me, they jack those 30-year mortgage rates, 10-year mortgage, business loan rates, whatever it may be, a whole heck of a lot faster than they're going to increase your savings account rate. It's just natural. It's just the way it works, the way the cookie crumbles from that standpoint. They're a little slow to increase your savings rate there. However, those savings have slowly started to creep up. Interest rates are kind of just hovering around the same spot that they are. So there's not really much of that gap as much anymore moving forward on a year-over-year basis. Now, as interest rates start to come down, as long as the economy is holding on, and that's what we've seen in all the data that we've seen, as long as the economy is holding on, financials can actually do good, because as rates come down, what does that do? That can spur some more growth. Some companies that were saying, man, we need to reinvest, but I can't reinvest right now at 8% loan. I need to take out a loan. I can't do it at 8%, 9% loans right now, interest rates. But if it comes down to 5, yeah, let's do that. Let's start jumping. Let's see if we can get a head start here on this new economic cycle. So lowering rates can do that to a degree, but also when interest rates start to lower, it also coincides with the economy that is starting to slow. So it's kind of a tug and pull there overall. So let me jump back. I know I've been talking there for a while. Let me jump back and see if we got any questions here. We got South Korea in the house, Israel. David bought some Microsoft. Sale on SCHD. What else we got? GE. Jim Betts. Good to see you, my friend. No rate cut right before the election will be, Michael says, no rate cut right before the election will be seen as Fed meddling. Belize is in the house. Michael thinks December we might get one. Energy plays. Yep, we just mentioned those right there. Awesome. So let's get back to our slide deck here, back to the iPad, and take a look. So that's where we're at year to date. Real estate, obviously high interest rates. Real estate's not going to do well. REITs aren't going to do well. However, again, long-term investor, you want to be an early mover. We're not backing up the truck right now. We've talked about that. I love REITs, but that doesn't mean we're backing up the truck. They are very cheap right now, but they're a sector that's cheap for a reason. So you can start nibbling it. That's what I'm doing. I'm just buying small amounts, small bits and pieces every once in a while here when it comes to REITs, because they're not going to do anything in the next 3 or so months, 3 to 6 months, however, until we have better direction on, yep, rates are starting to cut in December. Yep, rates are going to start cutting in November, things like that from that standpoint. So that's year to date. Let's take a look at 3 months. Energy up nearly 20%, blowing everyone away out of the water. And I've been talking about it for about 2 months now in terms of that sector. Again, real estate, the only sector in the red there when it comes to that 3 month performance overall. And then the 1 month, again, energy, top play overall there, followed by utilities and communication services. However, when we look at this now, we only have 3, really that's going to go red now in a second. We only have 2 sectors that are in the green over the past 30 days when it comes to the S&P 500 here, energy and utilities. And when you think about defensive sectors, those are 2 sectors that you think about, energy and utilities. Healthcare can be one as well. So that should be in the back of your mind when it comes to investing overall. So something to definitely keep an eye on there as we continue to progress here during the market. So let's get back to housing here. We talked about this is the spring housing season. This is the biggest season this is the Super Bowl when it comes to if you are a housing company here. New home sales came in at 693,000 sales. Economists were only looking for 668. It's the highest level that we've seen in the past 6 months. New home sales rose 8.8% on an annualized rate. The prior month on an annualized rate was actually revised down in a big way. It was 0.3%. It was revised down to negative 5.1%. So we had a big swing in terms of folks buying in February compared to buying in March. And again, it's taking an annualized approach. Median sales price 430,000.7. That's down about 2% year over year. And this is the tough part when it comes to, if you're looking for a home right now, supply fell 5.7%. And it's kind of, whatever side you're on. If you're looking for a home right now, you got high rates, not a lot of choices out there when it comes to homes. So there can be some bidding. If you're looking to relocate, you also don't want to get rid of that sub 3% mortgage rate. 4, 3, 2.5, whatever it may be, because you're going to be going to a 7.5% interest rate. You could have a house that costs way less and have a mortgage that's way more than what you have currently right now. It just doesn't make sense economically unless you're forced to, unless you had a job loss or a job transfer or really have to get closer to family or whatever it may be. You got to do what you got to do. However, from an economic standpoint, it might not make the most sense overall there. So good news though out of the housing market so far. So let's get to our first question of the day. Do you believe we will retest the lows of 2024? So we just saw the lows of 2024 so far. We had those last week when the S&P 500 kind of dipped from that standpoint. But do you believe that what we just saw, the little dip that we saw or where we started the year, the low point, we will retest that again in 2024? Or do you think we're off to the races and we're going higher and we're going to stay higher for the remainder of 2024? Let me know in the comments section. A simple yes, we will retest the lows and there's still more selling pressure to be done, or no, we are off to the races. Let me know in the comments section there. Michael believes we will. Ron believes we will retest. Jim believes we will. Cindy believes we will. J-Boy, yes, one more in May. James is optimistic and believes the worst is behind. John Bircher says yes. Ty says yes. Gretch, yes. So not a lot of optimism here out of our group so far. I hope so. I want the bargain, said Matthew. Anid said yes. Rob said yes. Ty said lower. Gretch said yes. Marcos said yes. Wow. This is an overwhelming answer. I didn't realize this was that big of a softball question overall, but I guess it is. C wants to buy the dip. Yep, we all want to buy the dip though. Hope so. Love buying the dip. There we go. We're looking for some bargain shopping here. Jeff Hansen says yes, this week even. We haven't seen the now. Let's get into some fun. Let's have a little fun here on the Dividend Power Hour. What do you say? You gotta mix it up and have some fun here on this Dividend Power Hour. It's NFL Draft Week, and if you're an NFL fan, let me know what your favorite team is in the comment section there. I won't let you guys know what my favorite team is because you guys probably won't like me as much anymore. So I'll keep it to myself, even though my whole wall over here to the side is flush with that team and its logo, whatnot. But let me know what your favorite team is and if you're excited about the NFL draft. But today, we're going to be doing a stock market draft. And here's the rules that you can see right here. You're going to be putting on your general manager hat. You're going to be the GM of your portfolio, and we're going to create a 3-stock portfolio here. All right, what are some of our favorite teams here? The Eagles. Uh-oh, Carl. Cindy with the Chiefs. Oh, Cindy's riding high. Rob with the Buffalo Bills. More Buffalo Bills. J-Boy with the Cowboys. Double exclamation point there. We got the Houston Texans, Arizona Cardinals. Jeffrey Hatch up in Washington, but a Niners fan. Josh Eagle is a Jags fan. Rob mentioning Buffalo again. He's that big of a fan there. Awesome. So you're going to be putting on your GM hat. We are looking to build a portfolio over the next 3 years. You can only have 3 stocks in your portfolio, and you can pick one from each tier. We have 3 tiers. So tier 1, you're going to be picking a stock. Tier 2, you're going to be picking a stock out of that group. And tier 3, you're going to be picking a stock out of that group. Once you pick your 3 positions, I want you to tell me in the comment section, what was your overall portfolio? How did you construct your team when it came to this stock market draft? So let's do some stock picks here. We got a lot of folks that have already joined the Dividend Power Hour now. And if you are just joining, this is the best time to join right now because we're having a little fun here with the NFL draft right around the corner here in less than 24 hours or about 24 hours, I guess. We're doing a stock market draft. 3 stocks. You pick one team or one stock from each and every tier. So we got 3 tiers, tier 1, tier 2, tier 3. You can pick one from each. Let me know in the comment section what it is. And Tesla does not equal Aaron Rodgers there. All right, so here is tier 1. So start making your choices. You don't have to put it in the the comment section yet. Just let me know once we get to the end here, what is your 3-stock portfolio? And again, this is, you have to think about not just this year, but the next 3 years. So some of these stocks are going to go through, some different periods here. NVIDIA's already had a big run, and we're looking to see who can have the highest performance overall. So tier 1, I cheated there and threw maybe an ETF in there to kind of throw you off. But NVIDIA, SCHD, Microsoft, Amazon, Meta, Alphabet, and Apple. So a lot of the Mag 7 right here. So think about what you're going to have for your tier 1. And let's go to tier 2. So here's our tier 2 choices. You have CrowdStrike, Netflix, United Health Group, Broadcom, Tesla, Home Depot, Visa, and Costco. So those are your tier 2 choices. So you get 1 from tier 1, 1 from tier 2. And now let's go over to tier 3, where we got a lot more choices, a lot more dividend stocks: Starbucks, Disney, Oracle, Eli Lilly, Procter & Gamble, Caterpillar, Coca-Cola, Lowe's, McDonald's. And I know some of you guys are fans of Bitcoin, so we have to throw Bitcoin in there. So there it is. There's Bitcoin. So there's our 3 tiers. Tier 1, one more time, tier 2, and tier 3. Let me hear, what are those portfolios? Next 3 years, you can't change it. These are the portfolios you're stuck with moving forward for the next 3 years. Let's hear it. All right, so Ty's got Microsoft, Amazon, and QQQ. That's cheating because those are all in tier 1. All right, what else we got? Okay, Microsoft for Gretch. Let's see what Gretch has. Microsoft, Visa, and Lowe's. Love it. Here's one. Joyce has got SCHD, Visa, and Starbucks. I love that one. SCHD, Home Depot, and Coca-Cola. Sean might be my favorite so far there. That might be one of my picks. Jeff Hansen's going Amazon, United Health. Oh, I like that one. And Eli Lilly. I like that. We got Microsoft, Visa, and Eli Lilly. A lot of growth right there. Jam-packed and some growing dividends. Apple, Visa, Starbucks. We got one Apple believer right there. SCHD, Visa, and Lowe's. Amazon, Costco, and Caterpillar. This is solid here. SCHD, Costco, and McDonald's. SCHD, Costco, Disney. Ty changed his mind. Microsoft, Tesla. Oh, I was wondering if there was going to be any Tesla fans in here. SCHD, Broadcom, and Lilly. And then Costco, SCHD, and Disney. Awesome. Well, hopefully that was a little bit of fun there that we had. That's our stock market draft there overall. And let me take a moment here to quickly tell you guys about my newsletter. If you're not already subscribed to my newsletter and you're looking for a one-stop shop that'll keep you up to date on what did the market do this week, number one, you could join the Dividend Power Hour. But if you like to read, it's sent to you early morning on the weekend, right when you wake up. Boom, you can do a quick little, it takes less than 5 minutes to read some of the top news stories that hit the market this week. What did the markets do overall and things like that. So it's completely free to sign up for that tier there. You got a free weekly recap, and we also send out a midweek recap, all sent directly to your inbox there. However, you can also become an Edge Plus member. This is for our premium subscribers looking to take that next step and get an edge in the market. You're going to get access to multiple portfolios, see all of our stock positions. We do a monthly portfolio deep dive or a portfolio update. We also have a Discord now. So if you are a part of the Stock Investors Edge, you have access to this Discord community where you can have quick access to both myself and Chris, who helps me at CMG Ventures, helps me run the Stock Investors Edge. We run it together there. So monthly portfolio updates. You get our top stocks watch list. You get earnings reports, which we're in the thick of it right now. And I'm going to show you exactly what do you get as a subscriber to the Stock Investors Edge here. So let me share my screen here real quick. Here's an example of the midweek recap that you get. So you can get, here's the Discord that we had. We sent this out today. So if you are on our list already, then you are going to be able to see this, and it's probably already in your inbox. We have the new Discord. So if you sign up, you'll see the link that you can get right there talking about how to get access to that Discord as well. So you can click on that, get access there. We do the Saturday update that we put within our Discord. So we just started it off. We just launched that last week, so it's still growing there, but we're doing Saturday updates. I kind of gave everyone an update on Saturday on what levels that we talked about. Chris is really good when it comes to looking at charts and things like that. So he gave his take on the Discord as well. So again, It's completely free to sign up. If you want to take things a step further, then you can do that as well. Become an Edge Plus member. So we have chat rooms, earnings rooms there. You'll see the economic reports, everything that's posted on our newsletter site. You can get access within the Discord. We have all the links right there. So it's a one-stop shop overall. So here's the midweek recap. You can see what the markets did. You can see our fear and greed index overall. And then midweek, we give you 3 stories. And then the post week, we give you 5 stories overall there. So stories here are about Tesla. And we'll be talking about Tesla here in a second. And you can see the majority of the companies that have already reported. And you can also see the ban there on TikTok that we talked about there. So you get a lot of information completely free when it comes to this one right here. So I hope you join. There's a link down in the description below to get signed up for the free version. And if you choose, you can also do the paid version, become an Edge Plus member there. We also have a free trial. If you want to try out the premium side, you could do that. There's a 7-day free trial that you can check out as well. So with that, let's keep rolling here. We have earnings season obviously underway here. A lot going on in terms of earnings. We've had Tesla, we've had Meta, we've had Visa, PepsiCo, along with a list of a number of different companies that you want to pay attention to as an investor there. So let's take a look at some of these key earnings reports here, beginning with, let's start with the good old Tesla. You guys know my favorite is Tesla, right? So let's go here. Let's take a look at old Tesla earnings. So this is going to be from our Investors Edge as well. So this is the earnings recap that you get if you are an Edge Plus member. So you could see kind of the write-ups that we have for everything. This is going to be going out tomorrow morning for anyone that's part of the free trial. But let's take a closer look here at Tesla. We could see their earnings per share came in at 45 cents, missed by about 10% from what analysts were expecting overall. How about revenue? Came in at 21.3 billion. Analysts were looking for 22.2 billion. A massive miss there overall. But what has Elon Musk done over a number of years? He has overpromised and underdelivered. So this was by far a horrendous quarter. I don't know if you are a Tesla investor already. I don't know if you're thinking about being a Tesla investor, but we're talking about a CEO that runs Tesla. We're talking about a CEO that is heavily involved in Twitter or X or whatever you want to call it, whether he calls himself the CEO or not. SpaceX, he's heavily involved there. He's also heavily involved in Starlink. I mean, this guy's got his hands in so many things. Brilliant mind, but when it comes to operations, can't say he's been hitting on all cylinders, firing on all cylinders. We've brought to market a Model 3, a Model Y, the Cybertruck about 5 years late. Overpromise, underdeliver from that standpoint. Deliveries down. Margins not that great. Sales down. I mean, it's really rough overall. Look at this. Revenue's down 9%. Net income down 48%. Free cash flow went to negative. Negative free cash flow is terrible for any company from that standpoint there. So, but what are they going to do? What is Elon great at from that standpoint? He wants to get people's attention. He wants to get investors' attention off of those horrendous earnings. They were horrendous earnings, however you want to look at it. But let me not focus on those horrendous earnings, and let me focus on this pie in the sky guess that's going to be 5 years down the road. But I'm going to tell you, there's a chance that those can come to fruition at the end of this year. I'm going to give you guys hope. I guarantee those cars won't be out until 2026 at the earliest. Look at the Cybertruck. What a disaster that was. The Cybertruck is now out. I think it looks terrible. The Cybertruck is now out. And what do we see? It makes no money. So we're going to go to this Model 2, this lower cost vehicle that the good part of it is it's not going to require any changes to their factories overall. So that's a good thing from that standpoint there. However, we're already seeing free cash flow under pressure. EVs as a whole, not just Tesla, EVs as a whole coming out. But they're still trying to tell me that, no, you can't. They're not a car company. They still are a car company. Most of their revenues come from that. You can tell me that what they expect, but they've been expecting a lot of this stuff for a number of years. You can't invest now for something that's 5-10 years out the road. You have to be forward looking when it comes to investing, but maybe 12 months. Not something that's going to be some pie in the sky. We're having flying cars and robo-taxis and things like that. He gave you a range of the 2026 or maybe even the end of this year. Like, do you have any idea, dude? It's just he completely got all of the attention off the horrendous job that his company, his management team, many of his managers that are leaving the company, which is also not talked about a lot. But I think it was a lot of retail investors that were jumping into Tesla after all of that because it sounds exciting. It sounds, I heard these big time analysts on CNBC talking about they're going to do this. It was just hope after hope after hope. There's no concrete plan that they have out there in terms of what is coming to fruition. What progress have you made that tells me that you're going to have this Model 2 by the end of this year? Robo-taxis is making progress. There's nothing fundamental except for them hoping. All of these analysts come on, it's hope, hope, hope. You can't invest on hope. You got to invest based on valuation. You got to look at a stock and put it into your valuation. If you want to add and say robo-taxis can add this much, don't make it a huge percentage of your overall valuation. You can put that into a model if you are, say, you're doing a discounted cash flow or things like that, but you can never invest solely based on hope. That's my 2 cents when it comes to Tesla. And I'm sure there are Tesla investors out there overall, but I mean, in the chat room here that may not like to hear that. That's just, how it is overall from my standpoint there. So let's take a look here at some more results. So we talked about revenue. We talked about earnings per share. Revenue was lower just due to falling sales prices, lack of deliveries. So we lowered our prices and we still can't make sales. Not a good sign there. China issues. Not a huge impact, I don't think, when it comes to FX. They've done a nice job incorporating into China, but China's a major problem for them. It's not helping anything like that. Tons of competition coming in overall. Higher self-driving revenue recognition. So, whether you want to see that, I know they cut that by about 50%. Do they have a head start there? Sure, they do there from that standpoint. So what are some of your thoughts when it comes to Tesla overall? Here in California, there's a million Teslas around. It's just a lack of, I don't know if you bought your Tesla 10 years ago or if you bought it yesterday. They look exactly the same to me. There's nothing that's changing. But if you bought a brand new Yukon, I know you have a brand new Yukon. I don't know if you have an old Tesla or not. So there's change. There's uniqueness coming to those other vehicles there, but not a stock that it still seems like it's a little bit rich in my eyes there overall. So what are your thoughts when it comes to Tesla overall? Earnings will determine the stock price eventually. John sold some Meta. Paying all that money for X had to cut in on some of the earnings. Tesla's the reason it was hard to own shares of Rivian last year. There we go. Cybertruck 5 years late and all recalled. Yep, great job there, Elon. Tron. Oh, there's another one. The Tron AI. Robocop don't think the Cybertruck looks bad. I did see one. There's one in my neighborhood that has a wrap on it. It's actually it's a night like a ruby red per se. Actually didn't look half as bad, that bad. But the other ones, the regular ones, probably not something you'll ever catch me driving. Elon tries to pump his own stock. It's exactly what he did when they did their stock cut. He tried to sell it as this is some great entry point that you can get into now. When there's stock splits, there's no additional value added to the company. None. If you had a company worth $100 and you had 2 shares out there, your shares are worth $50 each, 50-50. If you want to do a stock split, your company's still worth $100, but now there's 4 stocks out there. They're at $25 a piece from that standpoint there. So, but he sells it on it's cheaper. He's great. He's a mastermind from that standpoint. He's got great ideas. Operations, not his thing so far. So can he turn it around? Smart guy should be able to from that standpoint there. Not saying I could run the show or anything by that. But that's just kind of my thoughts on Tesla. We'll leave Tesla there. Doesn't really pay a dividend, but free cash flow is a major concern for me overall as well. Let's turn our attention. If you have to wrap your car, it's ugly. Good point there. Good point. Or maybe you just wanted to buy a cheaper color and then you can kind of create it whatever color you want. I don't know. All right, let's take a look now at Meta. So we got Meta that reported today, and it is getting hammered. It is down now 15% after hours there. Definitely a stock. I don't have any position in Meta right now, but definitely going to take a closer look. I like the digital advertising type of thing. What in the world happened with Meta? Well, let's take a look and see what happened here. So let's go to the Meta earnings report here. We could see Meta reported GAAP EPS of 471. 471, that actually beat by 39 cents. So a good little beat there overall in terms of EPS. Revenues came in at 3646, which beat by 240 million. So a slight beat, nothing crazy there in terms of, beating on the top and the bottom. But again, it's another company, another S&P 500 company that beat expectations. We saw a lot of expectations come down, especially over the past week when the market was falling off. Maybe things aren't as good as it was. Well, earnings are starting to show that, no, they're not all that bad. Shares down 8%. Yeah, not so much anymore since this was posted. Family daily active people was 3.24 billion on average. That's an increase of 7%. Ad impressions, this is that digital advertising type space there, increased by 20%. That's solid from that standpoint there. How much they're charging, how much they're earning from ads that companies are placing on the platform there, that increased by 6% year over year. However, this right here, folks, what I'm going to tell you next, this is why the stock is down so far. So first, let me premise, if we remember, what do we remember about 2023 when it came to Meta and Mark Zuckerberg? It was the year of efficiency. We were going to stop burning a hole and just burning cash when it came to his hopes again. Same thing we just saw with Tesla. We have a bunch of, pie in the sky type of hopes. We hope we're going to spend tons and tons of money on these hopes that come to fruition. There's areas to do that, but not the amount of percentage of actual free cash flow that a company generates that they're over there utilizing. You always want to have a piece of the business that is in those hope areas, but not the type of money that these guys are spending. So what did Zuckerberg pulled back entirely? And what did the stock do? It took off. One of the top performing stocks in the S&P 500, trailing pretty much only NVIDIA. So, okay, great. Now we're a much more fit company. We're still generating growth. We're still doing our R&D but we're doing it at a much more reasonable pace. We're doing it at a much more reasonable level. We got to spend cash to make money. We're doing that. However, we were being efficient. Now lo and behold, we get to this next earnings report here, the 2024 CapEx, which capital expenditures is the amount that the company's reinvesting, cash they're reinvesting back into the business. That's expected to come in at $35 to $40 billion. That increase from what they told us investors prior. It was going to be 30 to 37. Investors were fine with that. It's a good chunk of change right there. A lot of high quality companies that I could list off right now that aren't even worth $37 billion. And that's how much they're just reinvesting back into the business there. Well, those numbers have increased well above what analysts were expecting. So it has investors thinking, oh, here we go again. Zuckerberg's just we saw revenue forecasts come down. That's never a good thing in its own. But now we have CapEx budgets going up. So we're earning less and we're spending more. And it's just a nightmare for Meta investors that have been through it before, saying this guy just spends money like crazy. He got it under control. But are we returning back to that 2022 level where we started overspending per se? I think that's what investors need to learn a little bit more about. What are we spending? Why are the budgets increasing? What is that expected to give us as investors? What's it expected to generate for the company moving forward? That's going to be a key to answer. They may answer it on the conference call. Obviously, I'm not on the conference call because it's going right now, and I'm with you fine folks. So, all right, so that's Meta Platforms. What are your guys' thoughts? Are you owners of Meta? Are you looking to buy Meta on the pullback tomorrow? What are we down right now? Let's see. Still 15%. 15.3% right now when it comes to Meta overall. So you're going to get a nice little pullback. Let's see what that looks like on the charts here. So throw the charts back on for you. So let's go up here and let's go to Meta. ETA. We'll go to stocks. All right. So Meta Platform. So this is the chart right now. And you can see where we're sitting right now when it comes to Meta. We got back up to a high, but when it comes to looking at charts, you want to look at what's called gaps. Stock price has memory. And we could see that right around this period right there. Well, you're not going to be able to, let me change my pen here so you can see that better. Right there, you can see the stock shot up all the way to over 450. That was after their latest report there, their end of the year report. But as you can see, it never traded in this area right here. The stock has never traded in this little area here. That is a gap when it comes to Meta platforms. Stocks usually have to fill gaps, whether it's a gap high, gap lower, whatever it may be. So look now where the stock's trading at 419. What is it doing? It is filling that gap. So what is the next level I'm looking at as an investor? Well, where do we touch last? 406. So this stock could go as low as 406 is the next key level when it comes to Meta platforms. Down at 419, this thing can go lower over the next week or two. Could it bounce back off? Maybe intraday it gets down to 410. It's going to be right around that 406, 415 level is going to be filling that gap that we're looking at right there. I expect RSI is going to drop down here. If you look up top, anything close or below 30 is giving you an indication that that is a stock that looks oversold. We're looking to enter positions when they are oversold from that standpoint. So if you've been on the sideline, you're like, man, I missed this big uptrend in the stock overall, you're getting an opportunity again. If you like Meta, take a look at the earnings. Hopefully we get a better understanding of, okay, the CapEx is increasing, but why is it increasing? Hopefully there's an answer to that, and it'll help. Maybe the stock won't be down as much tomorrow. Again, these are just after hours. Never, expect after hours to be exactly right. Maybe it's only down 10% tomorrow. We don't know. We're going to have to wait and see, but be patient with it and understand it from that standpoint there. So definitely a stock I don't own, but looking to get into overall. If you kind of compare Meta to Tesla, I definitely would be much more interested, 1,000 times more interested in a stock like Meta right now. That doesn't mean I always am out on Tesla. That's that invest and homework piece that I talked about earlier. You constantly, maybe we'll get an update down the road, but we've seen this story before when it comes to Elon. Overpromise, underdeliver. So let's take attention off of the horrendous results and let's focus on these rosy things that, we'll have flying cars and robots and robo-taxis and all that stuff over here. We're an AI company. We're purely an AI company. That could be down the road, but it's not right now, and it's not anything that's particularly that close. That's the approach you need to take as an investor when it comes to investing there. So question here. I don't understand how Meta makes its money selling Facebook ads. They make a ton on ads. Digital advertising. Companies are advertising. Two of the spots that if you're a company that wants to advertise, you're going to go to Google or you're going to go to Meta. Not the only two, but those are two of the largest there overall. Ads. And they're looking for ways to monetize. They're starting to monetize Instagram Reels. They're starting to monetize Facebook Messenger. They have Threads, which I don't really use. I have one on there, don't really use it or looking that much. But that's how they make a good deal of their number. They're coming out with these, AI glasses or virtual reality type goggles and stuff that I probably won't own. But there's people out there that'll buy those high dollar type items there. So if you haven't seen them, you could walk around the Target. I've seen them in Target electronics area there overall. But again, they're not for everyone. So awesome. Well, let's keep let's wrap up this Dividend Power Hour here. Again, if you're interested, you've heard me talking about a lot of these terms, free cash flow, and we looked at different metrics like the PE multiple and looking at free cash flow yields and margins and operating margins and a lot of this stuff I'm talking about. I go through all of that within my 6-week investing accelerator course. There's a number of folks that have been through the course that I see on a weekly basis here in the Dividend Power Hour that made great strides from the first time that we met all the way through the completion of the course. And a lot of them still meet with me on a quarterly basis as we do check-ins from that standpoint there. We do portfolio overviews. Again, not a financial advisor, not going to go in and tell you to buy a particular stock, sell a particular stock right now and log into your account and do all that stuff. Nope, can't do any of that. But we can talk through how to value stocks. And I build out a full valuation cheat sheet. We go through actual companies. I bring over all the data for the companies that you choose. I let you choose, and we can go from that standpoint right there. So if you're interested in getting on the wait list, there's a link for that down in the description below as well. I'll stay for a few minutes. If you guys do have any questions off the top of your head that you want to go through, and definitely check out our newsletter right now, the Stock Investor's Edge. It's free to join. There's also a 7-day trial if you want to look at what's this Edge Plus all about. you can definitely sign up for that as well. Get access to our Discord, whether you're free or Edge Plus, and that's the easiest way to quickly get a hold of me. You get actionable alerts anytime I buy an ETF, anytime I buy or sell a stock. I post it in that trade alerts for Edge Plus members, so you can see all of that in there right then. So, business with Redbeard. How significant is ROIC in determining a business's quality? I think that's a big thing that you want to look at. ROIC is one of those things that you definitely want to focus on when evaluating a company. There's a number of things. ROIC you want to look at. I love margins. I love free cash flow margins, free cash flow yields. ROIC. If you want to go over and look at the balance sheet, let's analyze debt to EBITDA. You never want to focus or be fixated on one particular piece of evaluating a company. I like to look at a sum of the parts, because there could be one thing that you could be missing. I look at free cash flow a lot, and you can look at a price to free cash flow, which could be crazy, but there could be a story behind it. Maybe the company was reinvesting during those last 2 quarters per se, which threw off the free cash flow numbers over the trailing 12 months. Okay, well, let's move that one aside. What do the other metrics say? If the other metrics are good, and there's a story behind why the free cash flow isn't good, because management told us about this big reinvestment that they were doing over the next 6 months, 9 months, whatever it may be, then we understand that from that standpoint. Those are the types of things that I'm trying to help you understand more to be your own portfolio manager within that 6-week program there. So good question there. Cindy, thanks as always, Mark. Always learn from you. Thanks for tuning in, Cindy. I really appreciate that. I look for revenue growth. Revenue growth, a great place to start. But again, top line is just one thing. That's just one thing. If your sales continue to go up, but you don't have anything to show for it at the end of the day, your operating efficiency isn't great. Revenues can keep climbing, but if we're spending too much on having way too many employees, way too many buildings and retail centers that are underperforming, or spending too much on certain costs with certain vendors and things like that, it's all for nothing. Revenues can keep going up, but if we have nothing left over to show for it, no free cash flow, no operating income, no net income, there's issues there from a standpoint of future growth moving forward. Those are the things you got to analyze when looking at a particular company overall. Michael would love to know why LEG keeps dropping. I haven't seen anything on that one specifically, but again, I have a number of stocks that I watch right now that we're doing earnings recaps on for our newsletter. So I'll definitely have to take a peek at that one overall. Will SCHD dividend growth rate go back up? So it sounds like Josh might have watched my latest video there. It's really going to be fixated on the companies that are within it. So they have their 100 stocks that they always have. And the companies that have the largest weighting within SCHD, I don't think you can have higher than 4%, but until they do their rebalance all the time. But from that standpoint, it's going to be predicated on, look at those top 10 companies. Do they have fast dividend growth or not? That's going to kind of tell you where that dividend growth rate is going to be, at least over the next 12 months until they go through their reconstitution, which they do every single March. So right now, looking out ahead over the next 12 plus months right now, I fully expect that dividend growth rate to slow a lot. Doesn't speak to, it isn't meant to draw down SCHD and the quality, because they've been sticking to their algorithm for a number of years and it works. But in terms of dividend growth, which is something that I like to focus on, I focus less on dividend income, more on dividend growth, because if you're able to grow your dividend at a fast clip, that's also a company that tells me that they're generating a lot of free cash flow and they have a lot of confidence in their free cash flow moving forward as well. CPA stands for Certified Public Accountant. Not a competent, not a competent advisor. Jeff likes that. Yep. TradingView, you could use it as a free app. You can only choose a couple of stocks to look at and a couple different metrics, but they do have a paid version. I want to say it's like $10 or something like that. If you want to look at more things, I have a lot of watch list stocks on mine there. So it's a helpful tool overall. The Jay said the LEG earnings sucked. What do you think about Pfizer? Pfizer is one of those companies that have just been falling. I think what is it down? Like 40% or so. I recently invested into it probably 3 weeks ago or a month ago. It's on our latest portfolio update. It just seems like a stock that's extremely cheap based on the earnings growth moving forward. If you look at the PEG ratio, Very intriguing right there. And it's, you got to feel like, the floor is a little bit higher after a fall down from Pfizer. They had all of their pandemic sales that have just been wiped away now because there's not as many people doing all the vaccines and mandated stuff from that standpoint there. So now it's back to the Pfizer of old. We're done with a lot of that other stuff that we did over the past 2-3 years now. Now it's fixated on organic sales and what can the company do moving forward outside of any pandemic related sales. So when you look at the PE multiple and a number of different metrics right now, it looks intriguing from that standpoint. It seems like a higher risk or a lower risk, higher return type of investment right here. Doesn't mean it can't go lower, but if you're weighing the risk reward overall, that's why I chose to invest in Pfizer there. Sean, thank you, Mark. Learned something new today. Remember to smash that like button down below and subscribe to the channel. Thank you, Sean. Hope all is well. Isamu, there's a link down there. You can set up a call with me. We'll discuss one-on-one just to ensure that, number one, it's a good fit for you and go through some of those details there as well. Tokyo in the house. Nice. Do I recommend Johnson & Johnson? If you've seen my portfolio, and you could check out my entire portfolio by doing a free trial to our Investor's Edge, you will see that Johnson & Johnson is a core holding within my portfolio. Is it something I expect a ton of growth from? No. Is it something I expect a ton of dividend growth from? No. But they have a great management team. They're pharmaceutical. That they spun off their consumer health segment. Now they're left with pharmaceutical and medtech. Looking at the latest earnings report, I was actually a little bit more disappointed in the medical device sales. So not something I'm looking to add to right now. I think I added maybe 3-4 weeks ago or something like that, but not something I'm looking to add to anymore right now, just because, number one, the position size in my portfolio and the lack of their clarity moving forward in terms of medical device, because I saw other companies that were in the medical device segment, that sector of the industry or per se, that had good sales. So it was kind of like, were sales down? Was demand down? Or were you just losing market share? And I didn't like that much when it came to Johnson & Johnson. Do you like Kenvue? It's hard not to. Do I expect a ton of growth from a company like Kenvue? No. Stock price is way down since the IPO price. But, I mean, look at the brands. You got Tylenol. You have, all the toothpaste. You have all of the Band-Aids. You have the Motrin. You have all of the child's type stuff. The shampoo. I mean, it's a number of things there that they use for Kenvue that's used at every household practically on almost a daily basis. So it seems more like a safe investment rather than a high growth investment. So you got to understand, when you're buying stocks, you don't want to turn a blind eye to growth, and you don't want to be overextended to one particular sector or one particular type of stock there overall. So awesome. Well, that's wrapping up. I went a few minutes over, so thank you guys. We still have well over 100 people that are tuning in here with us. So if you haven't done so, again, smash that like button. My name is Mark Rushin. I'm a CPA here in the state of California. We are almost approaching 50,000 subscribers here on YouTube, and I can't thank you guys enough for all the support, getting to chat with you. Many of you that have taken my course. It's always great to meet all of you, and I look forward to these weekly power hours each and every week. And with that, I hope that you guys stay safe. Good luck in the market, and we'll see you next week. All right, take care.